Reading 46 of the CFA program, Curriculum Level 1, Reading 46, Market Efficiency. Learning outcomes. The candidate should be able to describe market efficiency and related concepts, including their importance to investment practitioners. Distinguish between market value and intrinsic value. Explain factors that affect the market's efficiency. Contrast weak forms, semi-strong forms, and strong form of market efficiency. Explain the implications of each form of market efficiency for fundamental analysis, technical analysis, and the choice between active and passive portfolio management. Describe market anomalies. Describe behavioral finance and its potential relevance to understanding market anomalies. Introduction. Market efficiency concerns the extent to which market prices incorporate available information. If market prices do not fully incorporate information, then opportunities may exist to make a profit from the gathering and processing of information. The subject to market efficiency is therefore of great interest in investment managers, as illustrated in example 1. Governments and market regulators also care about the extent to which market and prices incorporate information. If efficient market implies information prices that accurately reflect available information about fundamental values in market-based economies. Market prices help determine which companies and which projects obtain capital. If these prices do not efficiently incorporate information about a company's prospects, then it's possible that funds will be misdirected. By contrast, prices that are informative help direct scarce resources and funds available for investment to their highest value uses. Informative prices thus promote economic growth and efficiency of a country's capital markets, and is an important characteristic of well-functioning financial systems. The remainder of this reading is organized as follows, and here's the organization of the chapter. Concept of market efficiency. The description of efficient markets. An informationally efficient market is a market in which asset prices reflect new information quickly and rationally. An efficient market is thus a market in which asset prices reflect all past and present information. In this section, we expand on the definition by clarifying the time frame required for an asset price to incorporate information, as well as describing the elements of information released assumed under market efficiency. We discussed the difference between market value and intrinsic value, and illustrate how inefficient or deceptionaries between these values can provide profitable opportunities for active investments. As financial markets are generally not considered being entirely completely efficient or inefficient, but rather falling within a range between two extremes, we describe a number of factors that can contribute to impede the degree of efficiency of the financial market. Investment managers and analysts, as noted, are interested in market efficiency because the extent to which a market is efficient affects how many profitable trading opportunities exist. Consistently superior risk-adjusted returns are not achievable in an efficient market. In a highly efficient market, a passive investment strategy that does not seek superior risk-adjusted returns is preferred in an active investment strategy because of lower costs. By contrast, the very inefficient market opportunity may exist for an active investment strategy to achieve superior risk-adjusted returns as compared to a passive investment strategy in efficient markets. An achieved investment strategy may outperform a passive investment strategy on a risk-adjusted basis. An efficient market is a market in which asset prices reflect information quickly, but that is the time frame of. But what is the time frame of quickly? Trades are the mechanism by which information can be incorporated into asset transaction prices. The time needed to execute trades to exploit an inefficiency may provide a baseline for judging speed of adjustments. The time frame of an asset's price to incorporate information must be at least as long as the shortest time a trader needs to execute a transaction in an asset. In certain markets, such as foreign exchange and developed equity markets, market efficiency relative to certain types of information have been studied using time frames as short as 1 minute or less. Finally, an important point that an efficient market efficient market, prices shall be expected to react only to elements of information releases that are not anticipated fully by investors. Market value versus intrinsic value. Market value is the price at which assets can be currently or bought or sold. Intrinsic value is, broadly speaking, the value that would be placed by investors in that they have a complete understanding of the asset's investment characteristic. For a bond, for example, such information would include its interest rates, the principal value, the timing of its interest, and the principal payments, and other terms, the bond contract, a precise understanding of its default risk, the liquidation of the markets, the liquidity of the market, and their issue specific items. In addition, market variables such as the term structure of intrinsic rates and the size of various market premiums applying to the issue would enter the discounted cash flow estimates of the bond's intrinsic value. The word estimate is used because in practice intrinsic value can be estimated, but it is not known for certain. If investors believe a market is highly efficient, they will usually accept market prices as accurately reflect the intrinsic value. Discrepancies between market price and intrinsic value are the basis of profitable active investments. Active investors seek to own assets selling below perceived intrinsic value in the marketplace to sell short assets sellings above perceived intrinsic value. If investors believe an asset market is relatively inefficient, they may try to develop an independent estimate of intrinsic value. Numerous theories and models, including the dividend discount model, have been used to estimate an asset's intrinsic value, but they are all required judgment regarding its size, timing, riskiness, and future cash flow associated with the asset. The more complex the asset, its future cash flow, the more difficult to estimate the intrinsic value. Factors contributing to impeding the market's efficiency. For a market to be efficient, prices should be adjusted quickly and rationally to release new information. In other words, prices of assets in an efficient market shall fully reflect all information. Financial markets, however, are generally not classified as two extremes, as either completely inefficient or completely efficient, but rather between various degrees of efficiency. In other words, market efficiency shall be viewed as falling on a continuum between extremes of completely efficient at one end and completely inefficient. Market participants, one of the most critical factors contributing to this degree of efficiency is the number of market participants. Consider the following example that illustrates the relationship between the number of market participants and market efficiency. A large number of investors, individual and institutional, follows the major financial market closely on a daily basis, and if mispricings exist in the market, and thus, as illustrated by an example, investors will act so that the mispricings disappear quickly. Besides the number of investors, the number of financial analysts who follow and analyze a security or asset shall be positively related to the market efficiency. The number of market participants and resulting trading activity can vary significantly through time. A lack of trading activity can cause accentuate other market imperfections that impede market efficiency. In fact, in many of these market trading in many of these listed stocks is restricted by foreigners. For foreigners, by nature, the limitation reduces the number of market participants, restrict the potential for trading activity, and hence reduces market efficiency. Informational availability and financial disclosure. Informational ability and financial disclosure should promote market efficiency. Information regarding trading activity and traded companies in markets such as the New York Stock Exchange, the London Stock Exchange, and the Tokyo Stock Exchange is readily available. Many investors and analysts participate in these markets, and analysts coverage of listed companies is typically substantial. As a result, these markets are quite efficient. In contrast, trading activities and material information available may be lacking in smaller security markets, such as those opening in some emerging markets. Similarly, sufficient differences may exist in the efficiency of different types of markets. For example, many security types primarily for executively entirely in order over-the-top markets, including bonds, money market instruments, currencies, mortgage-backed securities, swaps, and for contracts, the information provided by the dealers and serves as market makers for these markets can vary significantly in quality and quantity. both through time across different product markets. Through treating all market participants fairly is critical for the integrity of the market, and explains why regulators place such emphasis on fair, orderly, and efficient markets. A key element of the fairness is that all investors have access to the information necessary for value securities that trade in the market. Rules and regulations that promote fairness and efficiency in the market includes pertaining to disclosure of information and illegal insider trading. For example, U.S. SEC's regulations, FD Fair Disclosure, requires that security issuers provide non-public information to some market professionals or investors that must be disclosed this information to the public. This requirement helps provide equal and fair opportunities, which is important in encouraging participants in the market. A related issue deals with legal insider trading. SEC rules, along with the court cases, define legal insider trading as trading in security market participants who are considered insiders while in possession of material non-public information about a security. Although these rules cannot guarantee that some participants will have an advantage over others, and an insider will not trade on the basis of inside information. The civil and criminal penalties associated with breaking these rules are intended to discourage illegal insider trading and promote fairness. In the European Union, insider trading laws are generally enshrined in legislation and enforced regularly by judicial authorities. Limits to trading. Arbitrage is a set of transactions that produces riskless profits. Arbitrage are traders who engage in such trades are to benefit from price discrepancies or inefficiency on markets. Such trading contributes to market efficiency. For example, if an asset is traded in two markets but at different prices, the actions to buy the asset in the market in which the underprice is sell and selling the asset on which the market is overpriced will eventually bring the two prices together. The presence of these arbitragers help prices discrepancies disappear quickly. Obviously, market efficiency is impeded by any limitations on arbitrage resulting from operating inefficiencies such as difficulties in executing trades in timely manner, prohibitively high trading costs, and a lack of transparency in market prices. Some market experts argue that restrictions on short selling limit arbitrage trading, which impedes market efficiency. Short selling is a transaction whereby an investor sells shares that he or she does not own by borrowing them from a broker and agreeing to replace them at a future date. Short selling allows investors to sell securities they believe to be overvalued, much in the same way that they can buy those that believe to be overvalued. In theory, such activities promote more efficient pricing. Regulators and others, however, have argued that short selling may exaggerate downward market movements, leading to crashes in affected securities. In contrast, some researchers report evidence indicating that when investors are unable to borrow securities that is too short to secure the security, or when costs to borrow shares are high, market prices will deviate from intrinsic value. Furthermore, researchers suggest that short selling is helpful in price discovery. Transaction costs and information acquisition costs, the cost of incurring by traders to identify and exploiting possible market efficiency affects the interpretation of market efficiency. Two types of costs considered: transactional costs and information acquisition costs. Transactional costs and information acquisition costs. In summary, the modern perspective of cause for investors to consider transaction costs and information acquisition costs while evaluating the efficiency of the market. A price discrepancy must be significantly large to leave the investor with a profit, and taking account for the transaction costs and information acquisition costs to reach the conclusion of the discrepancy may represent a market inefficiency. Prices may somewhat less than fully reflect available information without being a true market opportunity for active investors. Forms of market efficiency. Eugene Fama developed a framework for describing the degree in which markets are efficient. In his efficient market hypothesis, Lamau, imagine the efficient market hypothesis. Okay. Perhaps one of the least true hypotheses in finance. I don't know. Arguable. Markets are efficient when prices reflect all relevant information at any point of time. This means that the market prices observed or securities, for example, reflect the information available at the time. In his framework, Fama defines three forms of efficiency: weak, semi-strong, and strong. Each of these defined with respect to available information that reflects the prices, and thus is what it is. Weak forms, so semi-strong, and then Of course, we got the strong form. Implications of efficient market hypothesis, the efficiency of the implications of efficient markets to investment managers and analysts are important because they affect the value of securities and how these securities are managed. Several implications can be drawn from the evidence on efficient market and developed markets. Security markets are weak from efficient, and therefore investors cannot earn abnormal returns by trading on the basis of past trends and prices. Securities markets are semi-strong, efficient, therefore analysts will collect and analyze information, must consider whether information is already reflected in security prices and how any new information affects the security's value. Security markets are not strong forms efficient because security laws are intended to prevent exploitation of private information. Fundamental analysis is examination of publicly available information and the formulation of forecasts to estimate the intrinsic value of asset. Fundamental analysis involves the estimates of asset values using company data such as earnings and sales forecasts and risk estimates, as well as industry and economic data such as economic growth, inflation, interest rates. By the sales, decisions depend on whether the current market prices is less than or greater than the estimated intrinsic value. The semi-strong form of market efficiency says that all available public information is reflected in current prices. So what good is fundamental analysis? Fundamental analysis is necessary in a well-functioning market because this analysis helps the market participants understand the value implications of information. In other words, fundamental analysis facilitates a semi-strong efficient market by disseminating value-relevant information. Although fundamental analysis requires costly information, this analysis can be profitable in terms of generating abnormal returns if the analyst creates a comparative advantage with respect to this information. Technical analysis. Investors use technical analysis tends to profit with the pattern and the prices of the trading volume. Although some price patterns persist, exploiting these patterns may be too costly and hence would not produce abnormal returns. Portfolio management. If security markets are weak from a semi-form from efficient, the implication is that active trading, whether attempting to exploit price patterns or public information, is not likely to generate abnormal returns. In other words, portfolio managers cannot beat the market on a consistent basis, so therefore passive portfolio management should outperform the portfolio management. Researchers have observed that mutual funds do not on average outperform the markets on a risk-adjusted basis. Mutual funds perform on average similar to the market before considering fees and expenses, and perform worse on the market on average once fees and expenses are considered. Even if mutual funds are actively managed, the cost of managing these funds will reduce net returns. So what good are portfolio managers? The role of portfolio managers are necessary to beat the market, but rather to establish or manage a portfolio consistent with the portfolio's objectives. With appropriate diversification and asset allocation, while taking into consideration the risk, performances, and tax suitability substitution of the investor. Market pricing anomalies. Although considerable evidence shows the market are efficient, researchers have identified a number of apparent market inefficiencies or anomalies. These market anomalies are persistent and are exemptions to the notion of market efficiency. Researchers conclude that the market anomaly may be present if a change in the price of an asset or security cannot be directly linked to current relevant information known in the market or in the release of new information in the market. The validity of any evidence supporting the potential existence of market inefficiency or anomaly must be consistent over reasonably long periods. Otherwise, a detected market anomaly may largely be an artifact of a sample period chosen. In the widespread search of discovering profitable anomalies, many findings can simply be the product of process calls, data mining, and such data swapping. Okay, time series anomalies, calendar anomalies, momentum and overaction anomalies, cross-sectional anomalies, size effect, value effect, other anomalies such as the close-end investment fund discount, earnings surprises, initial public offerings, predictability of returns based on prior information, implications of investment strategies. Okay. Although the interesting to consider anomalies just described, attempting to benefit from these practices is not easy. In fact, most researchers conclude and observe that anomalies are not violations of market efficiency, but rather are the result of statistical methodologies used to detect anomalies. As a result, if the methodologies are correct, most of these anomalies disappear. Another point to consider is that in an efficient market, overreactions may occur, but then so do underreactions. Therefore, on average, the market are efficient. In other words, investors face challenges when they attempt to translate statistical anomalies into economic profits. Consider the following quote regarding anomalies from The Economist. It is difficult to envision entrusting your entire savings to managers whose strategy is based on buying securities on Mondays, which tend to have a negative return on average, and selling on a Friday. For one thing, the negative Monday return is merely an average. So on any given week, there can be positive. In addition, such a strategy would generate large trading costs. Even more importantly, investors would be likely uncomfortable investing in a fund strategy that has no compelling underlying economic rationale. Behavioral finance, okay. Behavioral finance examines investor behavior to understand how people make decisions individually and collectively. Behavioral finance does not assume that people consider all information in decision-making and act rationally by maximizing utility within budget constraints and updating expectations consistent with Bayes' formula. The resulting behavior may affect what is observed in the financial markets. In a broader sense, behavioral finance attempts to explain why individuals make that decision that they do, whether these decisions are rational or irrational. The focus of much of the work in the area is in behavioral biases that affects investment decisions. The behavior of individuals, in particular, their behavioral biases, have been offered as a potential explanation to a number of pricing anomalies. Most asset pricing models assume that markets are rational and that the intrinsic value of security securely reflects this rationale, but market efficiency and asset pricing models do not require that each individual is rational. However, only that the market is rational. If individuals deviate from rationality, other individuals are assumed to observe this deviation and respond accordingly. These responses move the market toward efficiency. If this does not occur in practice, it may be possible to explain some market anomalies referencing observed behaviors and behavior biases. Loss aversion. In most financial models, the assumption is that investors are risk adverse. Risk aversion refers to the tendency of people to dislike risk and require higher expected returns to compensate for exposure to additional risk. Behavioral finance allows for the possibility that the dissatisfaction results from a loss exceeds the satisfaction results from a gain in the same magnitude. Herding behavior has been advanced as a possible explanation for underreactions and overreactions in financial markets. Herding occurs when investors trade the same side of the market in the same securities, or which investors ignore their own private information and or analysis and act as others investors do. Herding is a clustered trading and may not be based on information. Herding may result in under or overreactions to information depending on the direction of the herd. Overconfidence, a behavior bias offered to explain pricing anomalies. Is overconfidence, and that if investors are overconfident, they overestimate their abilities to process and interpret information about a security. Overconfident investors may not possess information appropriately, and if there is a significant number of investors, stocks will be mispriced. But most researchers argue that the mispricing is temporary, with prices correcting eventually. If it takes a sufficiently long time for prices to become correctly priced, and the mispricing is predictable, it may be possible for investors to earn abnormal profits. Information cascades. Are informational cascades rational if informed traders act first and uninformed traders imitate the informed traders? This behavior is consistent with rationality. The imitating traders by the uninformed traders may help the market cooperate relevant information and improve market efficiency. However, the limitation trading may lead to an overreaction to information. The empirical evidence indicates information cascades greater for a stock when the information quantity regarding the company is poor. Information cascades may enhance the information available to investors. Other behavioral biases represent representative mental accounting, conservatism, narrow framing, behavioral finance, and investors. Behavioral biases can affect all market participants, from the novice investors to the most experienced investment managers. An understanding of behavioral finance can help participants recognize their own and others' behavioral biases. As a result of this recognition, they may be able to respond and make improved decisions individually and collectively. Behavioral finance and efficient markets. The use of behavioral finance to explain observed pricing is an important part of the understanding of how markets function and how prices are determined. Whether there is a behavioral explanation for market anomalies remains a debate. Pricing anomalies are certainly being uncovered, and statistical and behavioral explanations are offered to explain these anomalies. On the one hand, investors must be rational for efficient markets to exist. Then all the imperfections of human investors suggest that markets cannot be efficient. On the other hand, if all that is required for markets to be efficient is that investors cannot consistently beat the markets on a risk-adjusted basis, then the evidence does support market efficiency. Summary: this reading has provided an overview of the theory of evidence regarding market efficiency and has discussed the different forms of market efficiency as well as the implications for fundamental analysis, technical analysis, and portfolio management. The general conclusion drawn from the efficient market hypothesis is that it is not possible to beat the market on a consistent basis by generating returns in excess to those expected for the level of risk of the investment. Additional key points include the following: efficiency of markets is affected by the number of market participants and depth of analyst coverage, information availability, and the limits of trading. There are three forms of efficient markets, each based on what is considered to be the information used in determining asset prices. In the weak form, asset prices fully reflect all market data, which refers to all prices and trading volume information. In a semi-strong form, asset prices reflect all publicly known and available information. In the strong form, asset prices fully reflect all information, which includes both public and private information. Intrinsic value refers to the value of an asset, whereas market value refers to the price at which an asset can be bought or sold. When markets are efficient, the two should be the same or very close, but when markets are not efficient, the two can diverge significantly. Most empirical evidence supports the idea that securities markets in developed countries are semi-strong form and efficient. However, empirical evidence does not support the strong form of efficient market hypothesis. A number of anomalies have been documented that contradict the notion of efficient market efficiency, including the size anomaly, the January anomaly, and the winners-losers anomalies. In most cases, however, contradictory evidence both supports and refutes the anomalies. Behavioral finance uses human psychology, such as behavioral biases, in an attempt to explain investment decisions, whereas behavioral finance is helpful in understanding observed decisions. Market can still be considered efficient even if market participants exhibit seemingly irrational behavior, such as herding. And thus is reading 46. Remember, my show notes are in the descriptions. You guys just head to Amazon and grab the show notes. And that concludes Equity Investment Part 1, and we will get into Equity Investment Part 2 with reading 47 in our next reading. I do hope my readings have been helpful, and don't forget to grab your show notes on your way out. Without further ado, goodbye.